Hello there, fellow investors. I'm Iggy, and I'm excited to share my insights on dividend investing in Singapore, with a special focus on the Straits Times Index, commonly referred to as the STI. For those new to investing, the STI is a stock market index that represents the performance of the top 30 companies listed on the Singapore Exchange. In this discussion, we'll delve into the world of dividend investing and explore how the STI compares to other popular investment options in Singapore, such as real estate investment trusts, REITs, treasury bills, and Singapore savings bonds. We'll examine the benefits and drawbacks of each option, helping you make informed decisions about your investment portfolio. Whether you're a seasoned investor or just starting out, this conversation aims to provide valuable information and insights to support your investment journey. So let's dive in and explore the world of dividend investing in Singapore. Understanding the Straits Times Index, STI. Let's dive deeper into understanding the Straits Times Index, STI. Essentially, the STI serves as a benchmark that tracks the performance of the 30 largest and most influential companies listed on the Singapore Exchange. These industry leaders are the crème de la crème, representing various sectors and providing a comprehensive snapshot of the overall market's health. You'll recognize some of the prominent names that make up the STI, including DBS, UOB, OCBC, SIA, and Singtel, all of which are household names in Singapore. Recently, the STI reached a 6-year high, surpassing the 3,500 mark after fluctuating between 3,000 and 3,500 since 2021. Now let's talk about its performance over the past 5 years. The STI has delivered a total return of 24%, which translates to an annual return of approximately 4.4%. Notably, the index has been relatively stable during this period, and a significant portion of those returns likely stems from dividends, which is a crucial aspect to consider when evaluating the STI's overall performance. The STI's dividend yield. Now let's dive into the really exciting aspect of the Straits Times Index, STI, its dividend yield. Historically, the STI has consistently offered attractive yields, typically ranging between 3% and 5%, making it a tantalizing option for income-seeking investors. As of August 2024, the dividend yield is an enticing 4.8%, which is certainly a compelling reason to consider investing in the STI. But that's not all. Over the past decade, the STI has delivered an average dividend yield of 3.94%, which is quite impressive when compared to other major indices like the Hang Seng or the S&P 500. This means that investors who have parked their money in the STI over the long term have enjoyed a relatively higher income stream, which can be a significant advantage, especially in today's low interest rate environment. Advantages of investing in the STI for dividends. Investing in the Straits Times Index, STI, offers several benefits that can enhance your investment experience. One key advantage is diversification, which allows you to spread your money across various sectors and companies, reducing your risk compared to investing in just one stock. This is especially important in today's market, where uncertainty can be a significant concern. By investing in the STI, you're essentially spreading your eggs across multiple baskets, minimizing your exposure to any one particular company or sector. Another significant benefit is the potential for regular income. Many of the established companies within the STI have a proven track record of paying consistent dividends, providing a reliable income stream that's especially appealing if you're retired or seeking passive income. This can be a game changer for those looking to generate a steady flow of income without having to actively work for it. And let's not forget about growth potential. While our focus is on dividends, it's essential to note that the STI also offers the potential for capital appreciation. Over the past 5 years, the STI's total returns have outperformed its dividend returns, indicating that there's potential for long-term growth. Risks of investing in the STI for dividends. When considering investing in the Straits Times Index, STI, for dividends, it's essential to be aware of the potential risks involved. One significant risk is market volatility, which can impact the STI's performance and the dividends paid by its constituent companies. Economic downturns, geopolitical tensions, and sector-specific challenges can all contribute to market fluctuations, making it crucial for investors to be prepared for ups and downs. Additionally, there's always a risk that companies might cut dividends during difficult times. Although many STI companies have a solid track record of paying consistent dividends, there are no guarantees, and during periods of economic stress, companies may reduce or pause dividend payments to conserve cash. Another important consideration is sector concentration, as the STI has a significant weighting towards certain sectors, particularly financial services and real estate. As of June 2024, banks accounted for over 50% of the index, while real estate, mostly REITs, made up 16.5%. This means that any adverse developments in these sectors could have a disproportionate impact on the STI's performance and dividend payments. Comparing the STI to other investment options. Singapore REITs. REITs have been gaining popularity in Singapore, thanks to their high dividend yields and exposure to various real estate sectors. As of June 2024, the average dividend yield for Singapore REITs was 8.1%, which is higher than the STI. However, REITs come with their own set of risks. Their distributions can be affected by trends in the property market and how well they're managed. They can also be sensitive to changes in interest rates and property market cycles. Singapore Treasury Bills, T-Bills. T-Bills are short-term government securities that mature in a year or less. They're considered one of the safest investment options since they're backed by the Singapore government. The cutoff yield for the latest one-year T-bill is 3.38% as of July 2024. While this is lower than the STI's dividend yield, T-bills are often preferred by investors who prioritize capital preservation and modest returns. Singapore Savings Bonds, SSBs. SSBs are long-term investment products issued by the Singapore government. They offer a step-up interest structure, meaning the interest rates increase the longer you hold them. In the latest SSB issued in August, the one-year return was 3.19%, and the average 10-year return would be 3.22%. Again, this is lower than the STI's current dividend yield, but SSBs can appeal to conservative investors looking for consistent payouts and flexibility, as they can be redeemed without penalties. The bottom line. So there you have it, Iguanas. The STI can be an attractive option for dividend investors, offering diversification, regular income, and the potential for capital appreciation. However, it's important to understand the risks involved, such as market volatility, potential dividend cuts, and sector concentration. When comparing the STI to other investment options like REITs, T-bills, and SSBs, it's crucial to consider your personal investment goals, risk tolerance, and time horizon. As always, remember to do your own research and consider seeking professional advice before making any investment decisions. And don't forget to like, subscribe, and check out more content on the Investing Iguana channel. Until next time, stay savvy and keep swimming towards your financial goals.